Ever wondered if your money market fund at Fidelity is as safe as cash tucked away in a bank insured by the FDIC? That's a question a lot of people are asking, especially with so much attention on financial security these days. You've diligently saved. Perhaps you're parking some cash before making a big investment, or maybe you're just looking for a stable place to keep your short-term savings working for you. Fidelity's money market funds often come up in these conversations, known for their accessibility and competitive yields. But the crucial question remains, does that stability extend to the same level of government backing you'd find with a traditional savings account? Think about it for a second. The peace of mind that comes with knowing your deposits are insured by a federal entity like the FDIC is significant. It's a safety net, a guarantee up to a certain amount that even if the bank falters, your money is protected. Now, when we venture into the realm of investment products, even seemingly conservative ones like money market funds, the landscape of protection can look quite different. We're going to dive deep into the specifics of Fidelity's money market funds and unravel the intricacies of FDIC insurance. We'll explore what these funds actually are, how they operate, and critically, what kind of safeguards are in place for your investment. This isn't about scaring you or making you question your financial choices. It's about empowering you with the knowledge to understand where your money is and the level of risk, or lack thereof, associated with it. So, grab a cup of coffee, settle in, and let's get to the bottom of whether your Fidelity money market fund enjoys the same FDIC protection as your neighborhood bank. It's a fundamental question for anyone looking to manage their cash wisely and understand the nuances of different financial instruments. First things first, let's clarify what a money market fund actually is. Often perceived as a low-risk haven for cash, a money market fund is a type of mutual fund that invests in short-term, high-quality debt instruments. These can include treasury bills issued by the U.S. government, commercial paper, short-term debt issued by corporations, and certificates of deposit, CDs, from banks. The goal of a money market fund is typically to maintain a stable net asset value, NAV, of $1 per share, although, as we saw during the 2008 financial crisis, this isn't always guaranteed. Fidelity offers a range of money market funds, each with slightly different investment strategies and risk profiles. Some might focus more heavily on government securities, while others might include a mix of government and corporate debt. These funds provide investors with a way to potentially earn a higher yield on their cash than a traditional savings account, while still maintaining a high degree of liquidity, meaning you can typically access your funds easily. Now, let's tackle the core of the question. Are these Fidelity money market funds FDIC insured? The straightforward answer is no. Fidelity money market funds are not insured by the Federal Deposit Insurance Corporation, FDIC. To understand why, we need to look at the fundamental difference between a bank deposit and an investment in a mutual fund. The FDIC is a government agency that specifically insures deposits held in member banks and savings associations. When you deposit money into a savings account, checking account, or a qualifying certificate of deposit at an FDIC-insured institution, that money is protected up to $250,000 per depositor, per insured bank, for each account ownership category. This means that in the unlikely event of a bank failure, the FDIC steps in to ensure you get your insured deposits back. Money market funds, on the other hand, are investment products. When you invest in a money market fund, you are buying shares of a portfolio of short-term debt securities. You are not making a deposit into a bank. As such, your investment is subject to market risks, albeit generally considered low for high-quality money market funds. The value of your shares can fluctuate, although the aim is to keep it at a stable $1 per share. It's crucial to understand this distinction. The FDIC's mandate is to protect bank depositors, not investors in securities like money market funds. Different regulatory frameworks and investor protections apply to investment products. So, if Fidelity money market funds aren't FDIC insured, what safeguards are in place? While they don't have the explicit government guarantee of FDIC insurance, money market funds, including those offered by Fidelity, are subject to strict regulations under the Investment Company Act of 1940. This act sets rules designed to protect investors, including requirements for diversification of holdings, valuation procedures, and disclosure of fund information. Furthermore, Fidelity, as a large and well-established financial institution, has its own internal risk management processes and compliance measures in place. They have a fiduciary duty to act in the best interests of their clients. This means they are obligated to manage their funds responsibly and transparently. Different types of money market funds also carry varying levels of risk. For instance, government money market funds, which invest primarily in U.S. Treasury securities and other government obligations, are generally considered to be among the safest types of money market funds. These funds often aim to maintain a stable $1 NAV and typically have very low credit risk. Prime money market funds, on the other hand, can invest in a wider range of securities, including commercial paper issued by corporations. While still considered low risk, they may carry slightly higher credit risk than government funds. Tax-exempt money market funds invest in municipal securities and are designed for investors seeking tax advantages. It's important to carefully review the prospectus of any money market fund you are considering. The prospectus will provide detailed information about the fund's investment objectives, strategies, risks, expenses, and past performance. Understanding the specific types of securities a fund invests in can give you a better sense of its risk profile. So, while your Fidelity money market fund doesn't have the explicit backing of the FDIC, it operates within a framework of regulations and internal controls designed to protect investors and maintain stability. The specific level of risk can vary depending on the type of money market fund you choose. Understanding the differences between FDIC insurance and the regulatory oversight of investment products is key to making informed financial decisions. If your primary concern is absolute safety and you are comfortable with potentially lower yields, keeping your cash in an FDIC-insured bank account might be the most suitable option. However, if you are looking for potentially higher yields on your short-term cash while accepting a very low, albeit not zero, level of risk, a high-quality money market fund could be a viable choice. It all comes down to your individual financial goals, risk tolerance, and understanding of the different types of financial instruments available to you. Don't hesitate to do your own research, read the fund prospectuses carefully, and if needed, consult with a financial advisor to determine the best approach for your specific situation. Knowing where your money is and how it's protected is a cornerstone of sound financial management. With that said, thanks for watching and until next time.